Zurich Investments is based in Australia, but we are actually part of the global Zurich Insurance Group. Zurich globally is based in over 215 countries and has over 55,000 employees. Even though we're in Australia, we actually look to leverage our global reach as we search for investment managers that we believe are amongst the best in what they do. And then we look to bring that capability into the Australian marketplace for Australian advisors and investors. We've actually got a long heritage of doing this. We've been doing it for more than 40 years in multi-asset fund investing, but we also offer specialist solutions in Australian REITs, Australian small caps, as well as global equities. The fund's objective is to return 2.5% above inflation over rolling 5-year periods. Ultimately, what it's trying to do is provide investors with long-term capital growth and some income from a diversified portfolio that is managed by specialist investment managers. The fund looks to meet its investment objective by investing across a diversified range of asset classes. The first is its strategic asset allocation. That is the guiding principle, if you like, of how we mix the level of assets that we invest in across the portfolio. Once we've determined the strategic asset allocation, we then look to implement the strategy by using specialist investment managers. And that's where we believe that Zurich actually can offer some core value to investors relative to other products in the marketplace. And we also look to appoint managers that have differing styles or approaches to how they manage money, because in turn that blend will also help us manage the risk return profile of the portfolio. The final way that we look to add value or to meet the fund's investment objectives is via tactical asset allocation decisions. That's where we have a committee of investment professionals who try and look at the prevailing market conditions and see if there are opportunities where we can tilt the portfolio temporarily away from that strategic asset allocation benchmark with an objective really to either add incremental returns or manage risk if there are periods of market volatility. We construct the portfolio in a way that we believe gives it a good probability of meeting its investment objectives. In doing that, we look at the available investment universe from defensive assets such as cash and fixed income, all the way up to the growth assets that people are familiar with, such as equities. By blending those asset classes together, what we're really trying to do is make sure that the portfolio has a good chance of meeting its expected rate of return, but we're also optimizing it to minimize the amount of risk that we're taking at the same time. When you build a portfolio that's a little bit more conservative in nature, you'd probably expect to see a portfolio that has more exposure to cash and fixed income securities. And then as investors start looking for potentially higher returns and they have a higher risk appetite, you would see a portfolio dialing up its exposure to growth assets such as equities and property. So the managed growth fund actually has a higher return objective. So by its nature, you would expect it to have a higher weighting towards growth assets such as equities, properties and infrastructure. All in all, the portfolio is constructed with about 72% exposure to growth assets and 28% exposure to defensive assets such as cash and bonds. Once we've decided on that strategic asset allocation level, that's when we look to appoint the underlying investment managers. In doing that, we also look to blend differing approaches in the investment managers that we select, because that in turn will also provide us additional levels of risk management and diversification to improve the risk return profile of the overall fund. We then constantly monitor the performance of the portfolio, both the underlying manager performance to make sure that they're performing in line with our own expectations of their capabilities, and we also review the underlying asset allocation on occasion as well. What this allows us to do is ensure that there's sufficient flexibility in the portfolio to make any changes should we need to. Now that might be replacing one of the underlying managers, or it might also be using tactical asset allocation decisions to tilt the portfolio to areas where we think we can add incremental return. I think one of the points of difference that Zurich Investments has versus some of their peers is first and foremost the global reach that we have, and that allows us obviously to partner with specialist investment managers. So in turn, that really gives us a good capability where we believe we can add value for investors by strong investment manager selection. And then once we have selected those managers, we believe that we can add additional value or manage risk via our tactical asset allocation decisions. To make those decisions, we actually have a TAA committee that's made up of 8 members, including the Zurich portfolio management team, as well as external asset class specialists that we've invited onto that committee. I'd say that the Managed Growth Fund is more likely suited to someone who has a longer term investment horizon, and the benefit of that horizon will allow them to sort of ride through any short-term periods of market volatility. And the trade-off for that is that the portfolio, by its investment decisions and the assets that it's invested in, should allow them to earn some nice returns over the medium to long term over the rate of inflation. For over 40 years, Zurich Investments has been giving Australian investors access to specialist best-in-class investment solutions. We believe that's been offering them compelling long-term wealth building opportunities.